What's up, guys? It's Dan from Coin Bureau Trading. Today we're going to talk about a popular topic in crypto these days, and that's global liquidity and how it affects crypto prices. If this is the kind of content that you enjoy, then be sure to smash that like button, subscribe to the channel, and ping that notification bell. Before we get started, do keep in mind that nothing in this video is financial advice. It's just my personal analysis of the crypto market. Your analysis could be different, and if it is, that's awesome, because the more difference of opinion that we have, the better traders and the better investors we're all going to become. So I'll start off, guys, by just reading off a research feed post I did here earlier this week for our Coin Bureau Club members. And it was basically a frequently asked question as it relates to Michael Howe's updated liquidity forecast. You'll understand what that means in just a second. So to recap, one of the main reasons I believe the crypto market is likely to crash in late 2025 or in early 2026 has to do with the liquidity cycle, which is driven by debt refinancing. In 2026, institutions will need to start paying down debts with higher interest rates. The result will be a liquidity drain that crashes markets. This is based on Michael Howe's work, who is one of the top experts in global liquidity. For a long time, Michael has been saying that liquidity will peak sometime later this year and start contracting sometime in 2026. However, Michael recently did an interview with Raoul Pal, wherein he noted that the global liquidity cycle could extend into early 2026, specifically March 2026. Even though Michael advised caution, Raoul basically saw this as confirmation that his 2026 crypto cycle top call is on track, and of course the same is true for many other people in crypto for that matter. Anyways, naturally, the result is that many of you have shared the interview with me and asked me for my feedback/analysis. As one of our members pointed out, Raoul would constantly interject and make points arguing in favor of a continuation higher in global liquidity, while Michael would often ignore or just shrug it off. More importantly, there's one huge caveat that Michael didn't mention in his interview with Raoul. The image below, and I'll show it in just a second, the image below is from an interview Michael did a few weeks ago on monetary matters with Jack Farley, which is another great macro podcast. As you can see, different assets perform best at different stages of the liquidity cycle. When global liquidity is expanding rapidly, then risk-on assets tend to perform the best, including stocks and crypto. But as liquidity flattens/peaks, commodities take over as the top performing asset. And I'll quickly show you just the top of that image here so you see what that looks like. So you can see on the upswing in liquidity, equities perform the best. As liquidity kind of flattens out, that's when commodities take over, and then of course you get the crash and all this stuff. And this is again from an interview that Michael Howe did in a different interview where he showed this image. He didn't show it in the interview with Raoul Pal, at least not from what I saw. Now, in an image Michael shared in this interview with Raoul, he revealed that global liquidity is still expanding rapidly, but is likely to flatten in the next couple of months. This should correspond to a top in risk assets 2025, with commodities taking over at the liquidity cycle peak in 2026. And here again, I'll zoom in and show you guys so you can see here. The black line is of course global liquidity. The red line is like Michael Howe's projection. You can see the black line is rising rapidly here. It's probably that acceleration in liquidity is probably going to peak sometime basically by the end of this year. And then of course, when that liquidity peaks, when it actually starts topping, then commodities take over and then you start to see weakness in risk assets. And of course, that would suggest that going into 2026, you would start to see weakness in risk assets. And it's worth reiterating that Michael himself has been kind of reiterating, hey, we're late cycle here in the liquidity cycle, and you need to start being cautious. But of course, that flies over everyone's head when they're all, focused on this 2026 cycle top thesis. Anyways, guys, if you did find that research feed post interesting, this is the type of stuff that I'm posting in the Coin Bureau Club. That's where you'll find deep dives into small cap and mid cap altcoins. We actually basically review altcoins that our members vote on, so it's a really interesting mechanism there. Again, we have a research feed post where I'm sharing insights like the one that I just did. We have a team portfolio page where you can find the cryptos that we hold as well as the cryptos we're considering buying. We have an exclusive deals page where you can find deals on like crypto analytics platforms and stuff like that. And we have a members Discord where you can of course ask us questions, which is kind of like what prompted that research feed post to begin with. Anyways, guys, for the remainder of the video, I actually want to, again, credit where credit is due. Like Raoul Pal and Real Vision, like they do amazing work. Don't get me wrong, like I'm not like, of course, some criticism, disagreement, whatever, but Raoul Pal's an awesome analyst, and same with like Julian Biddle and all these other guys who are working at Real Vision. But it's worth kind of like, I guess, expanding on their thesis. And again, I don't want to like, I guess, straw man it or like water it down. But I guess the main thing, at least from what I've heard and seen, is that the main reason why a lot of people, whether it's, Julian or Raoul or whoever else, one of the main reasons why people believe that global liquidity is going to continue rising into 2026 basically has to do with with this assumption that the ISM, or which is kind of like you could say a measure of economic growth, that the ISM is going to start rising, and that's going to correspond to a rise in global liquidity. So I guess put differently, that there's going to be like an economic acceleration or economic reacceleration that's going to cause global liquidity to rise. And of course, I'm a little bit skeptical of this, but first let's take a look at the analysis. So this is what Julian posted here back in July. It's really funny that he was saying ISM is printing below 50 for what feels like an eternity and has been mind-numbingly dull, but this too shall pass. I actually remember Julian and Raul did an interview where they were kind of saying like, we were expecting the ISM to start rising, but it's not rising as much as we thought, right? And even if we look now, like more recently, you can see the ISM, yeah, I saw a little bit of an uptick you could see here in August, but still it's not really screaming some kind of like economic reacceleration, right? And of course, the simple reason for that, I would argue, is because the economy is actually not doing that hot. I would argue that we're actually headed towards a recession or something along those lines. And I'm sure a lot of you can feel that as well. What's really interesting here is if you look at basically the ISM composite index, so basically looking at services versus manufacturing, and you actually weigh them based on their how much they contribute to the U.S. economy. This is from Lance Roberts, another crypto, or I guess well, he's not a crypto trader, but another trader slash macro analyst, you could say. You can see that the ISM composite index, when weighed for the proportion of like what it accounts for in the economy, you can see that the ISM is basically just, this is from 3 weeks ago, by the way. You can see that the U.S. economy is really not looking that good. It's at like stall speed at the most. And of course, that begs the question, okay, like why is that? And like what would cause the economy to start actually reaccelerating and potentially, cause this liquidity boom in 2026 that Julian and Raul and so many others are kind of assuming or hoping will happen? In my view, guys, like the main driver, of course, of economic growth, and I think this is also a pretty well-known thing, one of the main drivers of economic growth has been government spending, like U.S. government spending. So of course, that means that if you want to see a reacceleration in the economy, then you need to see basically an increase in fiscal spending, but we haven't really seen that. I was actually looking at some CBO budget data here. Well, you can see here that there was a huge, surge in government spending in 2024, at least according to Trading Economics. But if you look at the CBO estimates, it's a little bit different. I believe that in 2024, let me just actually search this quickly here. I think it was 24%, if I'm not mistaken. Yeah. So in 2024, CBO data shows that federal government spending was approximately 24%. Their projection for 2025 is that it'll be slightly lower, so somewhere around 23%, which is of course going to be above the historical average. But assuming this is true, then it means that U.S. government spending is probably going to be less. But even if it's slightly more, like again, to see a reacceleration, you would really need to see a surge and increase, not just like a couple percentage points higher or lower. Like that probably doesn't matter. That's probably just a rounding error in the calculation. You would need to see a surge in government spending that really like kicks off the economy and boosts the economy. But we're just not seeing that fiscal impulse. And why is that? Simple reason, guys, because the bond market wouldn't be able to handle it, right? You need for the government to spend, they basically have to borrow money, right? Like of course, they only take in so much from taxes, and the rest they have to basically get by basically selling bonds to investors. And of course, investors don't want all these bonds because the value of those bonds are going to be inflated away. This is why you've seen, because of all the money printing, this is why you've seen global bond yields rising around the world. Governments around the world are spending a lot of money into their economies to kind of keep them propped up. Similarly to the United States, but the difference, of course, is that in the U.S. there are other industries and the stock market and other things that kind of like push the economy higher. A lot of it is like consumption driven. In other economies, it's not like that, and the governments are like spending as much as they can to try and keep their economies propped up. And the result is that bond yields, of course, are starting to rise because investors are like, look, like you're diluting the value basically of the currency, and I want a higher interest rate to compensate for that. And of course, that creates some problems in terms of borrowing, right, in the private sector, and it has all these side effects, right? Everyone knows that rising bond yields means rising interest rates, and of course, that's not good for the economy, right? So of course, that begs the question is like, okay, well, if you need to see a huge fiscal impulse for basically for the economy in the U.S. to reaccelerate, if you need to see a huge fiscal impulse, and the only way you can get that is by basically having the government get more money from bonds, it's like, how do you sell more bonds without raising the yield? And this is, where you could say the tinfoil hat comes out. Some of you guys might remember that in the spring when Trump was kind of like, quote unquote, purposely crashing the markets with the Liberation Day tariffs, there was a lot of speculation going around that Trump was purposely crashing the markets so that people, like basically investors, would rotate into safe haven assets, including bonds, right? And the idea is like, I'm going to create all this chaos and everyone is going to go into bonds, and then we're going to be able to basically like use that capital to basically spend into the economy and like boost the economy. Like I'm watering it down again, like super simplifying it. I could literally talk about this stuff for hours in case you couldn't tell. But the point being is that, once upon a time, there was a conspiracy theory that Trump was crashing the market to basically get investors to invest in U.S. bonds so that the U.S. and also to lower interest rates so that the U.S. government could refinance its debt, and all these people would be buying these bonds so that the U.S. government would have money in its treasure chest to basically, boost the economy. But of course, that didn't really happen, right? What happened is that the markets crashed, the bonds sold off, and it was like crap. Like, we have to kind of do a 180, right? And that's basically what happened. Everyone knows that. So, this is kind of like, you could say, my conspiracy theory take is that you could almost argue that a crash later this year, early next year, is almost necessary, or could be like, in the works to basically as a way of doing what they couldn't do earlier this year, was to get everyone to go into bonds. So basically, by raising the markets, up like crazy like they have been, and then having some crash later this year because of some other drama around like geopolitics or tariffs or whatever, you succeed in scaring people into bonds. You succeed in getting the Fed to drastically lower interest rates. Then you're able to refinance all these debts at a lower level, and then you're able to start spending that money back into the economy starting in 2026, so that the economy is surging and growing going into the midterm elections next year. And again, I apologize if that's a little bit off the deep end, or if like you're scratching your head or whatever. But I hope that makes sense. And if it doesn't, then let me know in the comments, and maybe I'll do another follow-up video on this, because it's a super fascinating topic. And again, like, people look at like correlations, for example, like ISM and global liquidity, but they don't really ask like why. Like, why does it happen? Why does the ISM rise? Why has the ISM been rising now? What does the ISM actually look like when you weigh it based on, manufacturing versus services? When you weigh it based on the economy, what does it actually look like? It doesn't look good. It's at like stall speed, right? So, okay, how are we going to get more economic growth? Well, if the public sector, if the U.S. government or governments in general are the ones driving economic growth, then of course that's where we're going to have to see another increase in fiscal impulse. But again, we can't do that without causing bond yields to rise. So the question is, how do you cause a fiscal impulse? Like, how do you raise the money required to basically re-inject it back into the economy to cause economic growth? And of course, the only answer is to find a way to basically trick people or convince people to buy bonds, and then later down the line, inject that money back into the economy to boost everything up, whether it's the economy and stocks and whatever, especially going into the midterms. As a final kind of like side note, part of the reason, again, you can just call this a conspiracy theory or whatever, part of the reason why I believe that a crash is likely later this year and early next year, besides like the liquidity cycle and besides like the crypto cycle and all that stuff, one of the reasons is that, we're not going to be up only into the midterms, and you can bet your bottom line that the Trump administration, they want to make sure that the markets and the economy are looking good going into the midterm elections. And the only way you can kind of do that is to, I don't want to say pull forward the crash, but you want to have the crash sooner rather than later, so that you have the crash, you have people buying the bonds now, so that you can reaccelerate the economy sometime later next year. And this could result in a shorter crypto bear market, and actually result in, prices rallying up to levels close to where they are today by the end of next year, which I'm sure a lot of you guys have been hearing about that, right? Is that when the Fed cuts rates, then historically speaking, markets are like higher or at similar levels like 1 year later. So me kind of like pitching that idea, that kind of makes sense. And this idea, it's just really crazy. Just as a side note, like another side note, that like you're seeing all these like crazy narratives. It's like, okay, like the markets are going to continue rallying into early or mid next year, and then we're going to get a huge crash. But at the same time, everyone is saying, oh, but like 1 year after rate cuts, the markets are higher. So you're saying that later next year there actually won't be a crash? Like, it doesn't make any logical sense, right? It's just crazy to see all these narratives kind of falling on top of each other. And I'm doing my best to try and make sense of that, especially for our Coin Bureau Club members. And I do hope that this little snippet of my analysis was helpful to you guys. Anyways, if you did make it this far and you did find that information helpful, then be sure to smash that like button, subscribe to the channel, ping that notification bell, and I'll see you in the next one.